What's up everybody, I am Jaspreet Singh and there's been a lot of growing fears about a potential market crash happening. And now with everything going on overseas, we're starting to see even more inflation on the side of food and our gas prices making everything so much more expensive. People are more worried about what's going to happen to our economy and the stock market. We're already seeing asset markets overseas, not in Russia, but in other countries get hit so hard because of everything going on in the economy and the geopolitical world. Just look at the European stock market. It's entering a bear market territory. And even Asian stock markets are now going into bear markets because of everything going on in the world. And all these economic and geopolitical factors have been affecting the United States stock market, which is why we've been seeing so much volatility up and down. Now, my goal here on YouTube isn't to make friends, it's to educate. So what I want you to do is, one, be aware of what's happening, and second, be prepared, because the reality is market cycles up and down are a part of our economic system. And what you want to do is be prepared for anything. Nobody knows when the market's going to crash. Nobody can time the market perfectly, but what you want to do is be prepared for anything. So when things go wrong, whether it's this year or 10 years from now, you want to be prepared. That way you can come out of whatever is coming next a financial winner. And this is what financial education is all about. So there are three things that I want to go over today. First, I want to talk about your portfolio and how you can build a robust portfolio no matter what is happening in the world. Second, I want to talk about how do you prepare. How do you prepare your finances? How do you prepare your investments? That way you can be ready for whatever might happen in the future. And third, I want to talk about how do you capitalize, because market crashes and recessions create more millionaires than any other time, but you have to be prepared and you have to know how to capitalize. This is where things get fun, and you want to be the person who's a financial winner, not the person who's getting financially screwed. And the only way you can do that is if you know how to prepare and if you know how to capitalize. So let's start by talking about number one. How do you build a robust portfolio? A portfolio is all of your investment dollars here. How is your money allocated? Now, for the average person, the only way that they invest their money is through the 401k, and you might have a few different funds that give you exposure to different stocks. One fund might give you exposure to the general S&P 500. One fund might give you exposure to the general stock market. And maybe you have a third fund that's a little bit safer that only gives you exposure to the blue chip, very strong, stable companies. Now, when you do that, that is your portfolio. But the problem with a portfolio like that is a lot of times your portfolio is very heavily weighted in just United States stocks. So now if the general stock market goes down, if you see a stock market crash, well then your entire portfolio goes down. So if you want a portfolio that can protect you from anything, you want to have a portfolio that's built for anything. And that brings me to this, the all-weather portfolio. The all-weather portfolio is a portfolio allocation method that is designed to withstand rain, snow, and thunderstorms all at the same time. So it's a portfolio style, it's a way that you invest your money in different allocations. That way now you can protect yourself against anything. All weather. It was created by Ray Dalio, the founder of Bridgewater Associates. I've talked about him a number of times on our channel. He is the most successful hedge fund manager in history. He started Bridgewater Associates, which became the largest hedge fund in history. And the way that he was able to do that was by, one, studying trends, and second, by investing money smartly. So he studied trends for hundreds of years, if not thousands of years, understood what has happened in the past, and took the past to predict what would happen in the future. And it has made him and a lot of his clients a lot of money. I mean, Ray Dalio is a multi-billionaire now because of his principles and because of his methods. So let's start by talking about his all-weather portfolio. So Ray Dalio's all-weather portfolio has money invested in three categories: stocks, fixed income, and commodities, with 30% going to stocks, 55% going to fixed income, and 15% commodities. So you have these three general categories right here: stocks making up 30%, fixed income making 55%, and commodities making the other 15%. But then he divides it up a little bit more. So if we start with commodities, you have 15% here of your portfolio going to commodities. And what he says, if you want to build this all-weather portfolio that can withstand anything, ups and downs, then in this commodities, you want to have half of this, so 7.5% is going to gold. And then the other 7.5% is going to a mixed, diversified portfolio of commodities to protect you against anything. And then when it comes to fixed income, which makes up 55% of our portfolio, he also divides this up a couple ways as well. So you have about 15% of this, which I believe is right there, which will be going to intermediate term bonds. So treasury bonds, United States treasury bonds, and you're going to be investing 15% of your money into the intermediate term bonds and the other 40% into long-term treasury bonds, LTTB, long-term treasury bonds, 40% of your portfolio there, and then the other 30% here, which is going into stocks. You want this to be invested into United States companies, United States stocks, and you can diversify your portfolio here by just investing into an ETF that gives you exposure to the general stock market. So this, according to Ray Dalio, is an all-weather portfolio that can withstand pretty much anything. And if we look at this chart showing the performance of the all-weather portfolio from 2010 until now, you'll see that the all-weather portfolio has grown quite a bit over the last decade or so, but compared to the S&P 500, which is the orange line right here, it hasn't grown as fast. Now, your goal with the all-weather portfolio isn't to achieve maximum returns, it's to get slow and steady growth. I mean, you can see in the S&P 500, you had these massive ups and downs. Like, look at this 2020 dip in the S&P 500 versus in the all-weather portfolio, you don't really have that. So the goal with the all-weather portfolio is if you see a crash here, this should protect you, or this can protect you. Or if you see a crisis in the dollar, well then this can protect you. So the goal with the all-weather portfolio isn't to get you the maximum returns, but it's to protect you against pretty much anything. That's why it's called an all-weather portfolio. Now, practically speaking, if you want to build out something like this, the easiest way to do that is just to have a number of different ETFs, and you can build a pie like this using M1 Finance, they're a sponsor of ours, and you can just allocate 30% to one ETF that gives exposure to the general stock market. You can allocate a couple different ETFs that give you exposure here, and you can allocate a couple different ETFs that give you this type of commodity exposure. So if you want to sign up with M1 Finance for free, I'll put the link to how you can do that down in the description. But essentially, if you want to build this, you just need to have the right platform, and then you need to have the right ETFs, and then every week or every 2 weeks, you're just going to keep funding this portfolio. That way you can keep building this type of portfolio. Now remember, the goal with this portfolio is not maximum returns, it's more protection. So if you do not want to be super involved with your investments and you just want to build a portfolio that will grow and will continue to hold its value, even if the stock market isn't looking very good, well then this might be something that you want to consider. But if you don't like the idea of just trying to withstand another market crash and you want to actually thrive through another market crash because you hear that more millionaires are made in market crashes and recessions than any other time, well then you got to do something a little bit different. You can have this be a piece of your investment portfolio, a piece of your investment pie if that's something that you would like. But if you really want to capitalize on what's going on in the world and you really want to capitalize on the next market crash whenever it happens, then the second thing you got to do is you need to be prepared. It's always funny to me to see how angry people get when somebody else starts talking about a potential market crash or why they're worried about a market crash. The reason why people get so angry when somebody else starts talking about a potential market crash is because they're so heavily invested in their portfolio, chances are they might even be in the red, and they hate the idea of losing more money in their portfolio because they're not prepared for what might be coming next. But what's interesting is if you talk to a seasoned or professional investor, they love the idea of a market crash because that means now you have the opportunity to come in and buy investments. You have the opportunity to buy assets for pennies on the dollar. But you have to be prepared, and that means you have to understand what's going on. So starting with the idea of being prepared, the first thing you got to do is you have to understand that market crashes happen. We see these type of cycles happen every 10 to 12 years where you have a boom and then you have a bust. Now over time, you have this upward trajectory of assets, but you have booms and busts and booms and busts and booms and busts. I mean, we saw this happen in 2020. We saw the stock market completely get obliterated until the Federal Reserve Bank opened up their money printer, and then they started pouring more money into the markets, which created the biggest crash and the fastest crash and then the biggest rally of the stock market ever. I mean, it was the fastest boom and bust that we've ever seen. But now we're starting to see the implications with that, with a lot of inflation and all of the issues in the economy because of what we did in 2020 and 2021. But you start to see these boom and bust cycles happen throughout time. We saw it happen in 2008. We also saw it happen in 2000 and 2001 when the dot-com bubble bursted. So the first thing you have to do is you have to understand that these type of cycles happen and they will continue to happen. I mean, if you go back centuries, the first recorded financial bubble was the tulip bubble in the Netherlands. I love talking about this because it's just so interesting that back in the Netherlands in the 17th century, you had a financial bubble around tulips. People thought that tulips, the flower, tulip bulbs, were going to be the most valuable commodity in the world. So some people started selling their homes. That way they could go out and buy one tulip bulb. So it all started with people starting to get really excited about flowers, these tulip bulbs, and then they started going up in price because there was a limited supply of them. Tulips aren't native to the Netherlands. And so when people started buying up all the tulips, all the financial people were looking at this saying, whoa, there's an opportunity here. What if we could buy tulips without actually buying a tulip? So they started creating these paper contracts to buy tulips. And now you had the financial markets investing in tulip bulbs, hoping that they could get rich on this whole tulip demand. So now the financial markets got involved and people started investing in tulip bulbs without actually owning any tulips. Nobody wanted to own the tulip. They just wanted to have the upside of owning a tulip. And this started to create this massive bubble around tulip prices because everybody on their version of Wall Street was buying tulips not to actually plant flowers, but to hopefully get rich quick. And this caused the price of tulips to skyrocket to the point where people were selling their homes to go out and buy a tulip bulb because they didn't want to miss out on this craze. And then all the flower people, all the flower shops said, wow, you're telling me that a tulip could be worth this much money? A tulip could be worth the price of a home? So then the flower shops had a massive auction to sell off some of their tulip bulbs. And they started the price of a tulip at the price of a home. And guess what? Nobody bought it, because nobody wanted to pay that much money for a tulip bulb. People just wanted to get rich off of the idea of a tulip price going up, but nobody actually wanted to own the tulip bulbs. And this ultimately burst the tulip bubble, and this was a craze known as tulip mania, and this was the first recorded financial bubble in history. So what you need to understand is that these types of booms and busts happen. And this is where it really pays to understand history. Now the funny thing about this is I used to hate history class when I was in high school and when I was in middle school. It never made any sense to me, and the teachers were always so boring. But now I love studying history. It's so weird how things change when you can pick and choose your teachers, because I love studying history now. I love studying financial history. I love studying general history. I mean, it's so interesting when you have a good teacher and you like what you learn, because it makes it so much more fun to listen to. But back then when the teacher sucked, it wasn't fun to learn. Once you understand that these types of booms and busts happen, the second thing that you want to do is now you want to prepare your wallet. Because if you want to go out and be able to take advantage of a market crash, you need to be able to have money or access to capital. That way you can buy things, especially when they're down. I mean, buy low, sell high. Makes sense, right? But if you want to actually be able to buy when things are low, you need money or access to money. That way you can buy when things are low. And that means you have to mentally be prepared to buy when things are low. Now, before I go any further of how you actually do this, let me give you a little bit of a disclaimer here, because my goal is now for you to perfectly try to time the market. It is impossible to time the bottom of a market. Nobody knows exactly when that's going to happen, and you don't want to miss out on all the upside before the bottom happens. So my goal is not for you to perfectly time the market, but if and when things go south, I want you to use this as a bigger buying opportunity. So what I like to do is I have a strategy where every week I have money entering the stock market. Every Wednesday I buy a few different ETFs that give me exposure to the stock market, and then I'm also eyeing some companies that I want to buy. When those companies go down and they get hard because of what's happening in the economy, that's when I come in and buy. And if they go even lower, I buy more aggressively. So what you have to understand is I'm not saying wait until a crash before you come in and buy, but if a crash happens, use that as an opportunity to buy strong assets at a discounted price. That's what Warren Buffett always says. It's not about timing the market, it's about time in the market. Time in the market is what will make you wealthy, but if you see this opportunity, you want to seize that and use that as an opportunity to come in and buy as well. Like I made my first real estate investment after the 2008 crash when home prices were at rock bottom. I wasn't investing in real estate before. I was young. I bought my first real estate investment property when I was 19 years old, and it was only $8,000. It was a condo. It wasn't the down payment. I paid $8,000 for the entire condo, and what was crazy is that just a few years before I bought that condo in 2012, that same condo was selling for $150,000. So that's what happened in 2008. I'm not saying we're going to see the same thing happen again, but what you have to understand is that you see these types of asset cycles, and when things go down, that's an opportunity for you to come in and buy even more aggressively. Now, when it comes to preparing, the very first thing that you have to do, I talk about this all the time when it comes to preparing for anything, is you got to be willing and able to live below your means. Live below your means. If you cannot do this, it is going to be impossible for you to take advantage of any market crash, and it's going to be impossible for you to build wealth, because anytime you make money, it's going out to make everybody else rich. Anytime you make money, you're making Amazon rich, you're making Lululemon rich, you're making Gucci rich, you're making Louis Vuitton rich, but the person that you're not making rich is yourself. So the first thing you have to do, no matter what, I don't care if we're talking about a market crash or not, you have to know how to live below your means. Now, I know this is not fun and this is not very exciting, but if you don't know how to do this, if you can't manage your money when you're making $25,000 a year, you will not be able to manage your money if you're making $250,000 a year, and you sure as heck will not be able to manage $2.5 million a year. So the very first thing you have to do is you need to know how to live below your means. You have to be able to spend less than what you make. And this is more important now than ever because we're entering a period of super high inflation. We're entering a period where the economy is slowing down. We're entering a period of a lot of geopolitical tension. So you want to make sure you're prepared. So that means start living below your means, that we have a buffer in your income. Now you're going to take some of this money and you're going to save a little bit for emergencies. Now, I'm going to put this in quotes here because these savings are not going to make you wealthy. Okay, the savings are just here to protect you against an emergency in case you lose a job, in case you can't work. That way now you have some cash to fall back on, but then this is where you need to invest. Now, when I talk about you investing your money, there's a couple things that you have to understand. I talk about the 75-15-10 plan a lot, which says for every dollar that you earn, 75 cents is the maximum that you spend, 15 cents is the minimum you invest, and 10 cents is the minimum that you save. Now, the thing that you have to understand about the money you put aside for your investments is there's two different strategies that you can follow. You can take all the money that you're putting towards your investments, so that 15%, and you can automatically invest it as soon as you get it. But then you're going to have no cash to invest if things go down. So you always want to have some cash that you can invest if things go down, because the interesting thing about any sort of stock market crash is the way that you can predict when the stock market is going to go down is by looking at cash on the sidelines. When investors have no more cash on the sidelines, that means investors are now fully invested. They're fully invested into the market and there's no more money to keep driving up the markets. Well, that means that the stock market is probably going to start trickling downwards because there's no more money, no more fuel to keep pushing it higher. But when investors have a lot of money on the sidelines, they're waiting for good opportunities. That means there's a lot of buying power, a lot of ammunition, and a lot of fuel that can push the stock market even higher. So if you're looking for a way to capitalize on a potential market crash, you don't ever want to be fully invested unless you have other ways that you can get some cash. Maybe if you have equity in other businesses, you have equity in real estate, you have equity somewhere else, well then that's something that you can borrow against and use that money to buy when things go down. But that does create another layer of risk because anytime you borrow money, that is risky. But that's something that I want you to be aware of. Now, this doesn't mean that you don't want to invest any money and you want to just keep accumulating cash because this cash is going to lose value relative to inflation. But there's something that you want to keep in mind. When you're putting your money aside, how much money do you want to invest right now? And how much money do you want to actively invest? Active investing means this is where you're looking for an opportunity. Not necessarily a crash, but just a better opportunity. And this is where you have to know yourself because this is a very individualized answer. Some of you watching this right now are gonna say, I don't really want to be that involved with my investments. I don't really care about reading earnings statements. I don't really care about following companies. I don't really care about looking for investments. I just want to invest my money and build wealth over time and let the investment market do its thing and let the stock market do its thing. If that's you, then you don't really got to worry about keeping cash aside to capitalize on a potential market crash. You just create a system where now every time you get paid, your money is automatically invested and you don't got to do anything. You don't touch your investments, you don't change anything, whether the market's up or down, you just keep investing your money no matter what. But if you'd like to be more involved with your investments, then maybe you have a much smaller allocation of your portfolio going towards your passive strategy. Your passive strategy meaning anytime you get paid, some of your money being automatically invested into ETFs. So if you want to be more actively involved, then maybe this money goes into cash, not directly into your portfolio, and then you are going to actively manage this cash. Maybe now you're actively looking for stocks. Maybe you're actively looking for startups. Maybe you're actively looking for real estate. You're actively looking for some sort of investment for you to invest your money. Like for me, I like investing money. I like looking for investments. I like the whole idea of being an active investor and looking for good opportunities. I'm not talking about being a trader, but being an active investor. But I still have a passive investment strategy. So because of that, I put most of my income towards my active investments, but I still have a passive strategy as well. Right now, I'm doing about $10,000 a month in my passive investment strategy, where I'm just adding another 10 grand a month. Now I know 10 grand a month is a lot of money, but it's all relative to the income that you make. I wasn't always putting 10 grand a month into my passive strategy, but you have to do what's right for you at the income that you are right now. So for me, my passive strategy and my active strategy are important, but I put less money towards my passive strategy than I do my active strategy, but you have to find what's right for you. My passive investments go into three different places. They go into stocks, they go into crypto, and they go into physical gold. So I have a portfolio on M1 Finance with a few different ETFs that's going into my stock portfolio every single week. Likewise, I have a few different cryptocurrency that I invest in. Bitcoin, Ethereum, then a couple of smaller ones, but most of the money is going into Bitcoin, followed by Ethereum, and then a little bit of money into some of the smaller coins. But that's what's happening every day in cryptocurrency, and then every month I do a buy of physical gold. I don't actually go to a gold dealer and buy some physical gold every month. I use a platform called Vaulted. They're also a sponsor of Minority Mindset, and that just allows me to buy gold on autopilot. If you want to learn more about them, I got their link in the description as well. But that's how I buy physical gold. And the last thing that you want to do to prepare is you want to earn more money, especially in the economy that we're in right now, where it's becoming more and more expensive just to survive. It's becoming more and more important in order for you to earn more money. So the way that you earn more money is going to depend, again, on you. If you're working at a company where you have the growth potential, where you can earn more money and you like where you're working, well, then you need to see how you can earn more money from your job. Maybe you have a revenue share program, maybe you have some commission, maybe you have some sort of upside where you can work harder and earn more money at your job. If you don't have that opportunity, then either you look for a new job, or you have another job that you add on, or you work to create your own side hustle or your own side business, whether it's in addition to your job or in replacement for your job. If you don't have any other income, then maybe you don't just quit your job and do your business full time yet until you have some income coming in from your business or your side hustle, but you need to start adding some more money into your financial system. This is so important now, not just so you can keep supporting your lifestyle and keep living below your means, but because you need to have more cash if you want to be able to invest more aggressively. Like the easiest way, I talk about real estate investing all the time. Everyone talks about how it's hard to invest in real estate because they don't make enough money, you don't have enough cash to put aside. Well, then you got to earn more money. You have to. And the way that you do that is, first, you have to understand that it is possible for you to earn more money. Okay? Not everybody grows up with financial education. I get that. I didn't. I wasn't told that I need to invest my money. I wasn't told that I need to be an entrepreneur. I wasn't told to be smart with my money. I was discouraged from doing any of these things because I was always told that if I wanted to become successful, there's one thing I got to do: study hard in school, get good grades, and then become a doctor. I guess there's 2 or 3 different things, but all falls under the same category of studying hard in school. That's what I was told to do. I was told not to worry about the stupid thing called entrepreneurship. I was told not to invest in real estate. I was told that all these things were dumb and they were wasting my time from my real financial success, which was by becoming a doctor. But the reality is, if you want to become successful, you have to start thinking differently. That's why I'm called the minority mindset, right? It's thinking differently than the majority of people. If you want to do that, you have to think differently, and that means first you got to start learning and then seeing how you can earn more money. Now, the important thing here is when it comes to earning more money, you get the best bang for your buck when you understand how to use your money the right way. Because for most people, if you suddenly just made some more money, you get a bonus, you get a promotion, you win the lottery, most of the money is going to get blown for the average person in just a few years because you don't know how to use your money. You get a bonus, you get a promotion, you celebrate with a brand new car, or you go on a vacation, you win the lottery, your lifestyle goes up. And that's why most people who win the lottery end up broke in just a few years, because you don't understand how to use your money the right way. So the first thing you got to do is you got to understand that when you start earning this more money, you do not want to have lifestyle inflation. Do not change the way that you live your life. Your life stays the same, but your income and your bank balance starts to change. So now this is how you start changing your life, because now you're putting more money aside towards your cash waiting to be invested. You put more money into your investments. You build your savings portfolio. That way now, you don't look any richer, but you're wealthier than ever before. This is one of the craziest and weirdest things, that if you want to become wealthy, you got to stop trying to look like you're rich. I mean, it sounds ironic, but the thing that holds so many people back from becoming rich is to spend all their money trying to look rich when they're not rich. It's not a matter of deciding whether or not a latte at Starbucks is worth it. It's the mindset of understanding where and when you should be spending money and when you should be stacking your cash. You have to develop that mindset, and you need to put some emphasis into knowing how to earn more money. And this is more accessible now than ever thanks to the internet, because now on the internet you can literally have access to billions of people around the world, which allow you to sell your products, sell your services, to sell anything to anybody. Now, it doesn't mean it's easy, but it is more accessible now than ever, so you need to understand how you can make money, especially on the internet. That way you can increase the income that you're making. That way you can fuel your system and be prepared for anything, because you also don't want to just be reliant on one income. If the company that you work for goes under, and now you're the person that has to look for a job and you don't have an income coming in, you're the person that has to pay the price. So you want to be prepared for anything. That means prepare your income, prepare your investments, prepare your savings, and prepare your lifestyle by living below your means now. The third thing that you want to do is capitalize on what's happening around you, and this is where things get fun. Now you're actually going to take action with the money that you have. But in order for you to do that, the first thing you have to do if you want to capitalize the right way is you want to make sure you're investing in your education. Because when it comes down to actually making money when a market crash happens, you have to be prepared and you have to know what you're going to do before it happens, because you have such a short time span where if you just start learning and you start researching and you start analyzing, you're going to miss out on some of the biggest opportunities. So you want to spend your time when things are good, understanding, preparing, and learning. So learning means now actually investing some of your time and your money into understanding what it is that you want to be invested in and how to actually invest your money. So one of the things that I do is I create a wish list for myself. Now I know a lot of people, when they talk about wish lists, they're talking about what they want to buy from Amazon or Gucci or Lululemon or Louis Vuitton. But when I talk about a wish list, I'm talking about which companies or assets that I want to own. So these are companies that I'm already spending time researching. These are companies that I've already spent time reading their earnings calls. These are the companies that I'm monitoring, and I'm just waiting for a good buying opportunity. Now, the reason why I don't share my personal wish list is because I don't want people just to buy whatever I'm looking at, because I have a different goal, different time span, different horizon, different everything, different strategy than you. And if people just start buying whatever I buy in 6 months, the stock is down, you're going to say, Jaspreet, I hate you because of you. I bought the stock and it went down, but I have a different time span and different goal than you. So this is where I want you to be financially educated. My goal is not to tell you what to do, but for you to be financially educated. That way you can make smart decisions based off of yourself and your own strategy. So the first thing I do is I create my own wish list, and then I'm always investing in my own education, right? So YouTube videos, books, classes, spend some time learning how to invest your money, whether it's stocks, whether it's real estate, whether it's startups. You start looking at where it is that you want to invest, and then you start researching how you do that. That way now, when the opportunity comes, you're already ready. They say that luck happens when you intersect hard work and preparation. Once you're prepared, you put in the hard work, then the opportunity comes, now you're ready to capitalize on it. Now, if you want to learn more about how you actually invest your money in the stock market particularly, you could check out a free lesson that we put together on Market Insiders. It's a free hour-long class that will walk you through how to invest your money in the stock markets. If you want to watch that class, it's completely free. I'll put the link to how you can do that down in the description. But now that you have the preparedness, now the question is, how and what do you buy? And the whole thing here is, when do you take advantage of this opportunity to come in and buy? There's a saying that goes, don't try to catch a falling knife. And the reason why that's so important in the stock market is because if we just try to diagram, let's just say a crash is this. How do you know when it's bottom? How do you know when you should buy? And the reason why so many people who try to time the market lose is because they can't time the top and they can't time the bottom. So what ends up happening for so many people trying to perfectly time the market is they see the stock market come down to here, and then they say, oh yes, this is the perfect opportunity for me to come in and buy, but I know it's going to go a little bit lower. And the market goes even lower, and now they get greedy. They say, oh yeah, this is a great opportunity for me to buy, but I'm just going to wait a little bit longer because I think the market's going to go down even more. And so then the market goes down even more, and now you're like, oh man, if I bought it today, I'll make so much money, but why buy today? The whole market is collapsing. Let me just wait a little while longer. Let it go down a little bit more. And then it starts to go up a little bit. And now you see it here, and now you say, man, this is way too expensive. I don't want to buy it here. This is just a dead cat bounce. People are just putting dumb money into the market. It's going to go back down. And then it goes up to here. And now you say, oh no, it's not going back down. Did I just miss the opportunity? It's way too expensive to buy here. I mean, it was just so much cheaper not that long ago. It's going to go back down, and now you wait, and now it's up here, and now you say, oh, well, I guess I missed the bottom. You missed the opportunity to buy. You see this type of emotions happen anytime people try to perfectly time the market. It's the same thing at the top. Nobody wants to actually sell it at the top because you always think it's going to go higher. And that's why people get greedy. They don't sell when it's high, and they don't buy when it's low because you let your emotions get in. Instead of trying to perfectly time the market, what you want to do is you just need to know what is a good price and a good opportunity for you. So let me give you an example outside of the stock market because it'll make it a lot easier to understand. When I invest my money in real estate, what I'm trying to do is I'm trying to get a 7% cash on cash return on my money every single year. So to break that down, what that means is I have a property that I want to buy. I already have my criteria for the location. If I find a good property in this location that I want to buy, and I can get a 7% cash on cash return on my money, meaning for every dollar that I invest, I want to make 7 cents in profit every single year in cash flow. This is a good deal for me. Now, my time and my work is trying to find this. It's not easy to find great deals that are going to pay me 7%, but that's where my time is spent. When I find a good deal that fits in the location, that fits my goals, that gives me the financial return that I want, I will buy it. So I've built the criteria and I know what price that I want to look for, and when I find something that fits my criteria within my price, it is a good deal. Now, I'm not trying to maximize it. If I find something that's 8% or 9%, that's great. But I know what my floor is. I know that this is a good deal for me. And if I find something here, it's a good opportunity for me to come in and buy. So now what you want to do here in the stock market is something similar. What's a good opportunity for you? What's a good price for you? And this goes into your own research. What type of price do you want to pay for a particular company? And one of the things that I like to do is I look at the price and I say, okay, if the price falls by 10 to 15%, I'll come in and buy. If it falls by another 10 or 15%, I'll buy more aggressively. If it falls by another 10 to 15%, I'll buy even more aggressively. There's something I like to call drip buying, where I buy when it goes down, and the further down it goes, I buy even more aggressively. And the further down it goes from there, the more aggressively I buy. So essentially, I buy on the way down, I buy it in phases, rather than just trying to perfectly time it at one point. I buy it in different phases, and then the further down it goes, the more aggressively then I buy. But when you're doing this, another thing that you want to be aware of is what's causing the downturn. Because if the company that you're invested in is going down because the company is about to collapse, that's not so good news. But if the company is going down because the economy is hurting, well then this is a good opportunity for you to come in, because if it's a strong company that's innovating, that has a good management team, that has a good moat around it, meaning not a lot of competition that can take its spot, well then this could be a good opportunity for you to come in and buy, because it's being hurt by everything around it instead of the company itself. But again, in order for you to make the smart decisions here, you have to be prepared financially and mentally. That way you have the ability and the capabilities to capitalize on whatever's happening in the world. This is why you want to be a financially educated investor, not an emotional investor. If you enjoyed this video, here's a video on the rules of money that I think you'll love. And while you're at it, you can download my free guide on how to start generating passive income by clicking that button below. Thank you for watching, and as always, keep hustling. I was always told not to talk about money, not to think about money. Money is bad. You shouldn't worry about money. But at the same time, I kept seeing everybody close to me, my parents, my family, friends,